credit is one of the most powerful financial tools, yet many people do not fully understand how it works, especially when it comes to the difference between business credit and personal credit. Both play a crucial role in your financial life, but they serve different purposes and are managed differently. If you are starting a business or already running one, knowing how these two forms of credit work can protect you, open opportunities, and help you grow without putting your personal finances at risk. Let us break this down step by step so you can clearly understand business credit versus personal credit. The first thing to know is what personal credit actually is. Personal credit is your individual financial reputation. It shows how responsible you are with money, loans, and credit cards. Your personal credit is tied to your Social Security number and is tracked by credit bureaus like Experian, Equifax, and TransUnion. Factors such as payment history, credit utilization, length of credit history, new credit inquiries, and the types of credit you use all determine your credit score. A good personal credit score can help you get loans, mortgages, credit cards, and lower interest rates. Now, business credit is similar in concept, but it applies to your company rather than you as an individual. Business credit is tied to your business's employer identification number, EIN, instead of your Social Security number. Just like personal credit, business credit shows how reliable your company is when it comes to paying bills, managing debt, and handling credit accounts. Agencies like Dun & Bradstreet, Experian Business, and Equifax Business track this information. Your business develops its own credit profile, separate from your personal one. One key difference is liability. With personal credit, you are personally responsible for all debts in your name. If you miss payments or default, your personal assets and credit score take the hit. With business credit, the responsibility shifts to your company. If you structure your business as an LLC or corporation, your personal finances are legally separated from your business. That means your personal assets like your car or house are not automatically at risk if your business struggles. However, in the early stages, many lenders still require a personal guarantee, meaning your personal credit might still be checked. Another major difference is how each type of credit is built. Personal credit grows through credit cards, car loans, student loans, and mortgages. Business credit, on the other hand, grows through things like vendor accounts, business credit cards, business lines of credit, and loans taken out in the company's name. Even paying for office supplies or utilities through accounts set up in the business name can build credit. The more consistent your company is in paying bills on time, the stronger its credit profile becomes. Why does this matter? Because strong business credit opens doors to funding, partnerships, and better terms. Lenders and suppliers look at your business credit to decide whether to extend credit or loans to your company. With strong credit, you might get larger credit lines, lower interest rates, and better payment terms. For example, a supplier might allow your business to buy inventory now and pay later, giving you flexibility in managing cash flow. Without business credit, you might have to rely on personal credit, which can quickly become risky. Personal credit scores are usually calculated on a range from 300 to 850. While business credit scores vary depending on the agency, Dun & Bradstreet's PIDEX score, for example, runs from 0 to 100, with higher scores indicating better payment history. Business credit scoring models are less standardized than personal ones, but they all measure the same core idea: whether your business pays its bills on time and manages debt responsibly. Here is an interesting fact: you can have excellent personal credit and still have no business credit at all. Many entrepreneurs make the mistake of relying only on their personal credit for business expenses. While this works in the short term, it mixes personal and business finances, which makes taxes messy and liability risky. By building business credit, you create a financial identity for your company that stands on its own. The benefits of separating the two go beyond just borrowing money. Having strong business credit helps you protect your personal credit. For example, if your business requires a large loan or credit line, using your personal credit can max out your utilization ratio, dragging down your score. With business credit, those activities stay under the business profile, leaving your personal credit untouched. This separation also makes it easier to qualify for personal loans, mortgages, or other financial products in your own life. Another difference is transparency. Personal credit scores are fairly easy to access. You can check them through apps and banks. Business credit, however, is public to some degree. Potential partners, lenders, or even competitors can often look up your business credit profile. This makes it even more important to maintain good credit habits in business, as your reputation is visible to others in the market. How do you start building business credit if you are new? The first step is to legally separate your business from yourself. Register as an LLC or corporation and get an EIN from the IRS. Then, open a business bank account to handle all company finances. From there, apply for a business credit card, which is one of the easiest ways to start building. Pay your bills on time, keep balances manageable, and over time your business credit will grow. You can also set up accounts with vendors who report payments to credit bureaus. Let us pause for a thought. Many entrepreneurs underestimate the long-term value of business credit. Imagine you want to expand your company in 5 years. If you have strong business credit, you can access capital without putting your home or savings on the line. If you rely only on personal credit, the risk becomes much higher. That is why learning this difference now can save you a lot of trouble later. One more point worth mentioning is tax preparation. Keeping personal and business credit separate makes it easier to organize your finances for taxes. When everything flows through a business credit card or account, you have a clear record of expenses to deduct. If you mix everything, you might miss deductions or struggle to prove expenses to the IRS. Here is one more point to strengthen the guide. Many lenders start you with a personal guarantee on early business credit, but you can graduate to business-only terms. The path is simple and disciplined. Keep 12 to 24 months of spotless on-time payments across your business card, trade lines, and any small loan. Keep utilization low, ideally under 30%, and show steady deposits through your business bank account. When those signals are in place, ask your lender to remove the personal guarantee or to refinance into a product that relies on the company credit file alone. Confirm whether a UCC lien was filed on your assets and request a release once the balance is paid. This reduces personal risk and proves that your business credit profile can stand on its own. Here is a second point that owners overlook. Not every vendor reports your payments, so choose trade lines that actually feed the bureaus and keep your business data clean everywhere it appears. Open Net30 or Net45 accounts with vendors that report to Dun & Bradstreet, Experian Business, or Equifax Business, then pay a few days early to target a PADAX score of 80 or higher. Keep your legal name, address, EIN, and industry code consistent across your bank, tax records, website, and directory listings, because mismatched details or a risky NAICS code can trigger extra scrutiny. Monitor your business reports quarterly and dispute errors quickly so you get full credit for the good habits you already practice. To summarize, the main differences: personal credit is tied to you as an individual, while business credit is tied to your company. Personal credit affects your ability to get loans, credit cards, and mortgages. Business credit affects your company's ability to secure funding, build relationships with vendors, and grow without risking your personal finances. Both require discipline, timely payments, and responsible use, but they serve different purposes. The smart approach is to manage both wisely. Keep your personal credit strong for your own financial needs while building business credit for your company's future. By doing so, you create two separate but powerful financial tools that give you flexibility, protection, and opportunity. Thank you for staying with me through this detailed breakdown of business credit versus personal credit. If you want more clear and practical guides that simplify money, growth, and business success, make sure to subscribe to our channel Success Lens, where we turn complex financial topics into easy lessons you can use right away.